Hello, my name is Dewey Fadilla. I will tell you about how to invest well. Follow me to the end. What do you know about investing? What investments do you use? How do they work to improve your financial performance? Of the many investments, do you know about currency investments? How much do you know about currency investments? What is the system? I'll tell you in this video. I will discuss measuring currency exposure, currency exposure relevation, exchange rate volatility. Exchange rates can change significantly in a relatively short period of time. Impact on payments and receipts. If a company engages in international transactions, such as payments or receipts in foreign currencies, exchange rate fluctuations may cause significant changes in the costs or revenues to be paid or received in foreign currencies. Impact on financial performance. Exchange rate fluctuations affect cash flow company, which then affects financial performance. Influence on payments and receipts in foreign currency. For companies that have payment or receipt contracts in foreign currencies, exchange rate fluctuations can cause uncertainty in terms of the amount to be paid or received. Therefore, companies need to measure exposure to exchange rates in order to anticipate these changes. Impact on costs and revenue. For companies that import raw materials or goods and sell them in the domestic market, if the domestic currency exchange rate strengthens, the cost of imported raw materials will be cheaper. Conversely, if the domestic exchange rate weakens, the cost of imported goods will increase, which can affect profit margins. Types of currency exposure. Transaction exposure. Transaction exposure. Definition. Transaction exposure refers to the risk arising from exchange rate fluctuations affecting the value of contractual transactions that a company has entered into with external parties, e.g., customers, suppliers, that use foreign currencies. This can include the purchase or sale of goods and services, as well as other financial contracts that are settled in foreign currencies. Exposure. Economic exposure. Definition. Economic exposure, also known as operational exposure, is the risk that arises from the influence of exchange rate fluctuations on the company's long-term cash flow. Impact on cash flow. Economic exposure involves not only existing transactions, but also changes in price competitiveness, market demand, and production costs. Translation exposure. Translation exposure. Definition. Translation exposure refers to the risk that arises when a company must translate the financial statements of a subsidiary operating abroad into the reporting currency of the parent company. Impact on financial reports. Translation exposure does not directly affect a company's cash flow, but it can affect financial statements companies, especially in the profit and loss and balance sheet. Fluctuations in foreign exchange rates may affect the recorded values of assets, liabilities, revenues, and expenses generated by a subsidiary when translated into the parent company's local currency. Conclusion. Types of currency exposure. Transaction exposure focuses on the impact of exchange rate fluctuations on contractual transactions that have been agreed in foreign currencies. Economic exposure more concerned with the impact of exchange rate fluctuations on cash flows and the company's long-term competitiveness in the global market. Translation exposure refers to the effect of exchange rate fluctuations on the financial statements produced by an international subsidiary when translated into the parent company's currency. Measuring economic exposure. The process of identifying and measuring the impact of exchange rate fluctuations on long-term cash flow companies, both directly and indirectly. Economic exposure is broader than transaction exposure because it involves the impact of exchange rates on the company's competitiveness, production costs, revenues, and other costs that can be affected by exchange rate fluctuations in the long term. How to measure economic exposure. Economic exposure includes a variety of factors that can impact a company's long-term financial performance, including price competitiveness in the international market, the impact of exchange rate fluctuations on operating costs, changes in consumption patterns and demand due to exchange rate fluctuations, The steps in measuring economic exposure involve two main approaches. Sensitivity analysis-based approach against exchange rate fluctuations. Regression-based approach to analysisto measure the effect of changes in exchange rates on changes in cash flow or income. Measuring transaction exposure. Measuring transaction exposure involves two main steps: estimate net cash flows in foreign currencies and calculate the impact of exchange rate fluctuations on those cash flows. 1. Estimated net cash flow in foreign currency. Estimation steps. Determine all expected cash flows from both receipts and payments in foreign currencies. For example, a company that exports products abroad may have receipts in euro. Meanwhile, companies that import raw materials may have payments in yen. Netting. If a company has transactions in the same currency with different receipts and payments, then the company must calculate cash inflows and cash outflows and distinto obtain net cash flow in foreign currency. Example: if a company has a cash inflow of 12 million euros and a cash outflow of 5 million euros, then the net cash inflow in euro is 7 million euros. Calculating the impact of exchange rate fluctuations. Explanation. Net cash flow in foreign currency calculated in the previous step. Exchange rate changes in the exchange rate between a foreign currency and a domestic currency, e.g., the US dollar. This can be calculated as the change between exchange rates over different periods. Exchange rate, the exchange rate in effect at the time the transaction is made. Factors that determine translation exposure. Proportion of business conducted by foreign subsidiaries. The greater the percentage of business conducted by a foreign subsidiary, the higher the potential translation exposure to the parent financial statements. This is because more transactions in foreign currencies need to be translated into the parent currency. Location of foreign subsidiaries. Location from foreign subsidiaries determines how much translation exposure changes in the exchange rate of the currency of the country where the subsidiary operates, and if the subsidiary is located in a country with a very volatile currency, then changes in exchange rates will significantly affect the consolidated financial statements. 3. Accounting methods used for financial statement translation. The accounting method used for translate subsidiary financial statements into the parent company's currency also affects translation exposure. 4. Inflation rate in subsidiary countries. High inflation rates in the country where a subsidiary operates may exacerbate exchange rate fluctuations, thereby increasing translation exposure, and if inflation in a subsidiary's country is very high, the country's currency may experience faster depreciation against the parent currency, affecting the translated financial statements. 5. Exchange rate fluctuations. Exchange rate fluctuations is the main factor affecting translation exposure. The greater the fluctuation in the exchange rate of a currency against the parent currency, the greater the potential the influence of exchange rate fluctuations to the consolidated financial statements. Conclusion. Translation exposure is strongly influenced by proportion of foreign subsidiary business to the total business of the parent company, location of foreign subsidiaries and the volatility of the country's currency, accounting methods which is used for translate financial statements, inflation rate in the country where the subsidiary operates, exchange rate fluctuations that occurred during the financial reporting period.